Imagine if I told you, you don't need 50 stocks. You don't need to watch the market every day. You don't even need to predict which company will be the next Apple or Nvidia. In fact, some of the world's wealthiest investors have built fortunes by doing something incredibly simple. They buy just 3 ETFs, and then they mostly leave them alone. It sounds too easy, but over the last several decades, this strategy, countless investors capture broad market returns while avoiding many of the mistakes constantly trading or chasing hot stocks. The classic 3-fund portfolio is built around a total US stock fund, an international stock fund, and a bond fund. So today, I'm going to show you the lazy investor portfolio, the same investing philosophy that has become one of the most popular long-term strategies among index investors. And by the end of this video, you'll know exactly how to build, even if you're starting with just $100. Before we begin, this video isn't about getting rich overnight. It's about getting rich slowly. Because here's the truth. Most people don't lose money because investing is impossible. They lose money because they make investing far more complicated than it needs to be. They chase meme stocks, they panic during market crashes, they buy whatever is trending on social media. And 6 months later, they're wondering where their money went. Meanwhile, there are investors who spend less than 10 minutes each month managing their portfolios. Let's play a quick game. Imagine 2 investors. Both start with the exact same amount of money, but they react very differently to the market. One stays calm while the other panics and fails. Investor number 1 reads financial news every morning, trades constantly, checks stock prices every hour, owns 40 different companies, believes they can beat the market. Investor number 2 owns just 3 ETFs, invests every month, never watches financial news, rebalances occasionally, then goes back to living life. Who do you think wins over the next 30 years? Most people would probably pick the first investor, but history suggests that many active investors underperform simple, diversified strategies, and emotional decisions can hurt long-term returns. The hardest part of investing isn't finding the perfect stock, it's staying disciplined through market ups and downs. The 3-fund portfolio is built on a simple idea. Instead of trying to guess which company will win, own almost the entire market. One fund gives you broad exposure to US companies. Another adds international companies. The third provides exposure to investment-grade US bonds, helping reduce overall volatility. Together, these 3 funds can provide exposure to thousands of companies around the world while keeping costs low and making the portfolio easier to manage. And that's why many long-term investors prefer this strategy. Not because it's exciting, but because it's simple enough to stick with for decades. So, what exactly are these 3 ETFs? And why does each one play such an important role? That's where things get interesting. In the next section, we'll break down each ETF one by one, explain what it does, and show how each piece works together in a long-term portfolio. Let's start with the first and arguably the most important piece. Instead of trying to guess whether Apple, Nvidia, Tesla, or Amazon will outperform next year, what if you owned all of them? That's exactly what a total US stock market ETF is designed to do. Rather than betting on one company, it gives you exposure to thousands of publicly traded US businesses in a single investment. Think about it. If tomorrow another company becomes the next trillion-dollar giant, you don't have to predict it. Your ETF will already own it once it becomes part of the market. That's the beauty of index investing. You're not trying to beat the market. You're becoming the market. Consistently outperform broad market indexes after fees. That's why so many experienced investors choose simplicity over constant stock picking. Now here's the mistake many investors make. They believe America will always outperform every other country. Maybe it will. The truth is, nobody knows. That's why the second ETF focuses on international stocks. Funds such as Vanguard Total International Stock ETF provide exposure to developed and emerging markets, outside the United States, globally. Imagine owning companies from Japan, United Kingdom, Canada, Germany, Australia, South Korea, and many more. If one country slows down, another may be growing. Instead of relying on one economy, you're investing in businesses around the world. Diversification isn't about predicting the winner. It's about making sure you don't depend on only one winner. Think of it like this. Would you rather own one restaurant or a share of thousands of businesses across dozens of countries? Most long-term investors prefer the second option. The third ETF, the shock absorber. Now let's talk about the ETF that many beginners don't like. Because it isn't exciting. It's the bond ETF. Why would anyone buy bonds when stocks usually grow faster? Because investing isn't just about maximizing returns, it's also about surviving market crashes without making emotional decisions. A broad US bond ETF can reduce portfolio volatility and provide stability during periods when stock markets are under pressure. Imagine your portfolio during a major downturn. If 100% of your money is in stocks, watching your account fall 30% or 40% can tempt you to sell at the worst possible time. A bond allocation won't eliminate losses, but it can help soften the ride and make it easier to stay invested. Sometimes, the best investment isn't the one with the highest return. It's the one that helps you stick to your plan. Now let's talk about how the three ETFs work together. Now let's put everything together. ETF number 1. This These and Churches that owns thousands of American companies. ETF number 2 adds companies from the rest of the world. ETF number 3 helps reduce volatility through high-quality bonds. Together, you own a diversified portfolio that spans global equities and investment-grade bonds while remaining simple to manage, has remained a favorite among long-term index investors. And here's the best part. You're not constantly asking, which stock should I buy next? Instead, you're asking a much better question. Am I consistently investing for the long term? But there's one big question left. How much money should you put into each ETF? Should it be 100% stocks, 80% stocks, and 20% bonds? 60% US and 40%? The answer depends on your goals, your time horizon, and your tolerance for risk. In Part 2, we'll build the portfolio step by step, discuss sample allocations for different investors, and cover the biggest mistakes that can derail even the simplest investing strategy. And don't forget to like, subscribe, and turn on notifications for more beginner-friendly investing videos. Thanks for watching, and I'll see you in the next video.